Well, hello, and I'm going to have a little bit of look at some of the sort of background issues that um, do have a bearing on what happens for the fund um, going forwards. And to start off with, I thought I'd have a little bit of a look at the sort of economic background that we have to work with. So, economics, I am rather cynical at times about the big economists out there and the forecasts that they make, because quite frankly, they often just get it wrong. I know in the past, in my firm, we had an economist who really did get it wrong virtually all of the time, but at least he was consistent. And our biggest worry was that one day he might actually get it right. So clearly, what I'm saying here is there are so many moving parts in the economy, within economics itself, that actually that's why it really is very hard to predict the future as such. So I've given a few examples there. The oil price, which I'll come back to, events like COVID, and you'll be able to see that graphically as well, and incidents like the invasion of Ukraine and more recently the events in the Middle East. So basically, I'm not going to give you any forecasts, but I'm hopefully going to work around a few of the factors which will indicate a direction of travel. So that does mean that your guess is probably about as good as mine, if not better. Um, the important thing to remember, however, that this does provide the background for the fund's investment strategy. So it is important that our investment team understand what is going on in the outside world when they're looking at the detail of the investments that they're making. So I really do love this cartoon, actually. It does at times, I always sort of think that markets actually have lost touch with reality of what's going on out there, and markets carry on to higher levels when you actually think the economic background is actually telling you that they're in trouble. So, is the economy actually off the edge of the cliff? Well, the answer is probably it's teetering on the edge at the moment. Now, I know this is a very busy slide, and I don't expect you to be able to read all the individual countries that are lurking in here. This is the GDP growth outcome for the second quarter of this year. It's too early to have the most up-to-date information for quarter three, but it does give you a little bit of an idea of the balance at the moment of across the world of economic growth, or for that matter, lack of it. So the United Kingdom is the highlighted section in the middle there, where growth in quarter two was just 0.2%. This group as a whole was up 0.5%, and the G7 group, which is just further to the right slightly, is up 0.7%. Now, is that going to be the case as we move forward? That's open to debate, because certain countries, and important countries at that, such as Germany and France, are certainly teetering on the edge of recession. The US has actually been rather more buoyant, and of course that's a major economy, and a lot of that is driven by an exposure to technology that other parts of the world have, including developed Asia, but not necessarily on a worldwide basis. So let's have a little bit of a look at the UK in particular. So this shows you that actually the impact of COVID, which I referred to earlier, had a huge short-term impact on GDP. So COVID struck in 2020, in basically the first half of that year, and you can see the impact that sort of lockdowns and restrictions had to the economy, and of course the bounce back which occurred, and then further lockdown. So that's one of the reasons why trying to predict things on a long-term basis can be upset very easily. What is also clear from this is the fact that the UK economy is actually going nowhere. It's flatlining. You can see that growth has been at zero or just above that level for quite some time. So let's have a little look at that in a bit more detail. So here we are. This is a sort of 10-year view plus some idea going forwards from there. And again, within that, you can see that it's been quite volatile. You can see 2020 showed a drop. It's got a forecast position to be improving very slightly as we move forward. But if we take an even longer term view, which is over the 50-year period, this starts to show something really quite disturbing. So you'll see that right through to basically the global financial crisis, we're doing very nicely, thank you very much. But since then, it's been stagnant. And even worse, if you look to the right-hand side, you will see that the trend line is now, the actual is dropping below the long-term trend line. Now, we'll return to this in a moment, but it actually does underscore why the government is trying to stimulate growth. One of the reasons is that if you look at the makeup of the UK economy, we actually have a lot of mature industry lurking within it. And what we lack is the engine rooms of growth that, for instance, the United States have, which is in technology. So no wonder the government is trying to sort of encourage investment in venture capital in new technologies to actually bring the UK back to a point where it is actually involved in the growth sectors. Now, moving on and starting to have a little look at sort of some of the underlying factors that we're having to deal with, and again, it's something that the investment team here have to tackle with. Now, one of the questions we've seen is about the whole aspect of inflation and the impact. Now, inflation has fallen from the heady peaks, and you saw a 10.1% increase, as Ewan referred to earlier, in pensions payable from April this year. Excuse me. The increase for next April will be 6.7, which has already been referred to. Now, that is actually, to Ralph McNally's question, is good for our pensioners, and I'll tell you for why, is that it's highly unusual for a pension fund to be in a position where it actually pays the rate of inflation as an increase. I'll give you an example of what you might see from a corporate pension scheme. I'm a member of one, and increases are capped at 5%. So yes, we are some way short currently of the cost of living increases, but actually in relative terms to other areas of the economy, we're in a good place. Inflation is corrosive. It's corrosive to savings, and it's corrosive to effectively the spending power of the individual. So it is important that inflation is brought back down, and that's why the government is taking measures, and the Bank of England, to bring that more under control. But I have to say that I am in the camp that inflation will stay higher for longer, and there are a number of reasons for that. Let's look at a few of those. So the oil price is very volatile, and unfortunately, it is outside of the sort of normal economic controls as such. It's unpredictable due to geopolitics, and also to a degree by price fixing by some of the major producers. So unfortunately, with the current scenario out there in the world, it's unlikely to fall far anytime soon. Let's come back to that sort of inflation and average earnings angle. You'll all be well aware of the headline figures, and the truth of it is part of inflation is attracting, obviously, demands for higher wage increases to, at least to some degree, cover that increase in inflation, and the cost of living issues. Excuse me. There is an issue here that actually the UK labour market, in a sense, had been cushioned for a long time by a ready supply of what I would call cheap overseas labour. So post-Brexit and actually also post-COVID, there has been quite a change in the labour market. A lot of that so-called cheap labour has gone home. And actually during COVID, a lot of people changed jobs because hospitality was effectively closed down, and because hospitality is a harsh world in which to work. Wages are low, hours are long, and frankly, customers can be pretty dreadful. So a lot of people were very happy to become van drivers instead and have not returned to hospitality. So there are quite a number of issues out there which are structural and they won't go away anytime soon. The one thing which may ease pressure on the labour market could be recession. And to be honest, we've got to say that would not be a good thing. Let's have a quick look at interest rates and which way we go from here. I've provided on purpose a long-term chart to show this. I'm one of the generation that saw 15% mortgage rates when I first bought a house. So the idea of anything below 10% was always in cloud cuckoo land to me at the time. But here we are, we've had a period of 15 years of very, very low interest rates. As part of the mechanism to control inflation, interest rates have moved higher. And I have to say that I think it's unlikely that we'll see a return to those levels seen post 2008. This does produce a major squeeze on the consumer and also brings quite unpleasant implications for house values as possibly people start to struggle with their mortgage interest payments. I just wanted to also highlight the sort of impact of the economic environment that to a degree was around the Trussonomics incident, shall we say, of a year ago. But you will see that bond yields were already rising before that, but peaked out, fell away again, but actually have risen once again to the similar sort of levels that we saw. Now, actually, that makes buying government bonds more attractive for pension funds, and more so than for quite a long time over the last 15 years. Now, it does start to make it more attractive considering what we as a fund have to earn each year just to stand still. But there is an implication of this, that there is a higher cost to the government of servicing that debt. If I may move on now to just a little bit about the recent consultation on LGPS investments. At the July Mansion House speech by the Chancellor, Jeremy Hunt, he did herald the long-awaited further consultation on LGPS pooling and investments. And it was meant to be a bit of a sweep up of a lot of issues which have been outstanding since what was basically a failed consultation in 2019. Now, going through some of the issues that were raised in this and some of the questions, I'm glad to say that West Yorkshire Pension Funds and our Northern Pool partners actually appear to be in a very good position. But what we have got to be aware of is there is a rising tide implied in here of reporting requirements. And I have to say that that actually has implications not only in terms of costs, but actually the personnel required to be involved in producing those enhanced reports. Now, there are a number of elements within the consultation, which I won't go through here because actually you can read the responses on the website and you can see what sort of questions which are raised. Underlying this is the suspicion that it's yet another money grab by Her Majesty's government. Well, yes, it is. But let me tell you this, it's not just the current administration who will be after your money, but actually, I believe that the Labour Party as well will be seeking ways of financing growth in the economy. So clearly they have had a handy, the Treasury itself has had a large influence on this consultation. But as I've said, what happens next is unlikely to change if there is change of political control. Just so you're aware of, within the consultation, there is a suggestion that 5% of fund assets should be in some way invested in helping levelling up across the UK, and 10% of assets should be in private equity, or actually, it would appear what they really meant was in private markets generally. Now, I think it's quite important here to say that there has been a strong response to some of those proposals, including from our own scheme advisory board. And actually, it does point out that it is not the job of government to be the asset allocators for the LGPS, or for that matter, to really suggest a direction of travel. How, around that particular aspect, it is vitally important that the LGPS as a whole and the funds within it take control of their own investment agenda and don't allow ourselves to basically be a pot of money to be spent by the Treasury or directed by the Treasury or for the Department of Levelling Up. Now, we are in a strong position with our levelling up investments already, and there is further work that we will be undertaking with our partners in Northern Pool in this respect. Now, one of the things about the LGPS is quite often we have seen ever since George Osborne started on this road with infrastructure, is that LGPS funds historically and going forward with our pools have been extremely good at actually determining good asset allocation, determining the returns that they require to meet their liabilities, i.e. paying pensions. As a fund, we are committed to supporting the communities that we serve. We aim to be bigger in general terms and better as we move forward in all that we do. And to close, our aspiration is that you are proud to be members of the West Yorkshire Pension Fund and all that we stand for. Thank you.
Thank you for that. Okay, so we did have a number of questions from members, many of which we've answered as part of the presentations or just after the presentations that we've already had. We have some that are still remain outstanding. First of all, question 3, it says, I believe the fund is committed to reducing its carbon emissions by 50% by 2030. What does carbon emissions refer to? Is it the amount of emissions caused by fossil fuel that is extracted and processed by the companies in which the fund invests, or emissions of the fund's own administration, its building, office costs, travel, etc.? Second that.
It was a very interesting question, this one. I'd not really thought previously about whether we could measure the carbon footprint of West Yorkshire Pension Fund's own operations. I think the difficulty will be extracting what we do from what Bradford Council does. But it's something I will think about whether there's a way of measuring that. When we talk about carbon emissions and carbon footprint as a fund, we're really talking about our investment holdings. The data in this space is less than perfect. So public market investments, public equities, public quoted bonds, there is generally information on those companies' carbon footprints. Private market assets such as private equity, direct property, private credit, there isn't, unfortunately, at the moment much information in that space. So a reasonable proportion of our portfolio was covered, but some of it isn't. So we do a carbon footprinting exercise each year where we measure the carbon footprint of our holdings. It's broken down into 3 categories. There's 3 what they call scopes. So scope 1, scope 2, scope 3 emissions, which is probably direct emissions of that company, indirect emissions, and then emissions in the supply chain. One of the other data problems is an element of double counting. So the carbon emissions in the supply chain of one holding will be direct or indirect emissions in in another portfolio holding. But there is information out there that we do monitor on a regular basis.
And the next question, a bit longer. Some national politicians claims that we're all on track to meet our climate targets, so we can relax. Extract more oil, slow down the transition to sustainable oil. Position is not shared by climate scientists who call for more comprehensive and urgent action. West Yorkshire Pension Fund investment strategy aims for a net zero portfolio by 2050. What real tangible progress has been made toward this target? Is West Yorkshire Pension Fund doing enough and fast enough to improve the climate impacts of West Yorkshire Pension Fund decisions?
Well, I was wondering whether I could actually answer question 4 and question 5 at the same time without asking you to read out another long question.
So I'll do question 5 as well then, which is, by how much has West Yorkshire Pension Fund reduced its carbon emissions in the last 12 months? Is there an implementation plan with annual targets to set out the reduction by 50% by 2030? If there is, can it be published so that members could hold the fund administrators to account for its delivery?
Okay, thank you. I'll try and answer both of these questions at once because they're obviously on a similar subject. On this slide, I thought I had a slide setting out our standard response to this question. I can read it out because I've got it written in front of me. The fund has developed a responsible investment policy and sees climate change as an existential threat to the planet and recognises the need to act. To that end, we have made a commitment to cut the carbon emissions of the fund to net zero by 2050. We're in the process of implementing the strategy and have published a task force on climate-related financial disclosures, explaining how we intend to identify, measure and mitigate climate change risk. Much more information on our website on this topic. As I set out in the answer to question 3, it's something we measure on an annual basis. We have this net zero by 2050 target. It's not going to be a smooth journey to this target. The most recent carbon footprinting report we received was a little bit disappointing compared to the previous years. There are very good reasons for this. There's a bit of a lag in the data. So most of the data which has come through in the most recent carbon footprinting report that we've received relates to the holdings in 2021 of our portfolio companies. And as Philip was describing on his slides, 2021 was the year where economic activity really bounced back post-COVID. So I think the carbon footprint of our portfolio holdings may be slightly higher in 2021 for that reason. We have got information, though, on a lot of our holdings for 2022. They're not in that carbon footprinting report, but we can go into the annual reports of these portfolio holdings and look at the carbon figures that they've disclosed. And several of our biggest holdings, which tend to be our highest emitters, have shown quite big decreases in carbon footprint in 2022 compared to 2021. So I'm pretty confident that our carbon footprinting report next year will be better than this year's. In terms of publishing the information, there is a document that we published called the TCFD report. We will update and publish this. Some of the members online may remember that there was a consultation out about a year ago on how these TCFD disclosures would be implemented in the local government pension scheme. Big pension funds, big trust-based pension funds have been subject to these TCFD requirements for a little while now, maybe a year or so, or 18 months. It's getting phased in sort of in size of scheme. Bigger schemes go first and it's going down to smaller schemes in due course. We had sort of assumed that it would be a relatively simple job for government to ask local government pension schemes to do a similar thing as big trust-based schemes. There was a consultation on it about a year ago, and I think the responses to it were fairly positive, but for some reason government hasn't yet introduced this requirement into the LGPS. So we have reported on a voluntary basis. I think we will continue to do so. We had hoped the government would set out exactly what our requirements are in this area, but they haven't. So I think we probably need to publish something on what we think would be a suitable level of disclosure, similar to what we've done previously. One final point I think I'd probably like to make on this subject is I think we all want a real world impact here. What we really want to see is our portfolio holdings reducing their carbon footprint. We've got some holdings in the portfolios we know are quite big emitters. there's obviously the fossil fuel companies that get regularly mentioned. Another big emitter is a company that makes building materials such as cement called CRH. So, for example, us to be selling or reducing our holdings in CRH, whilst it would make our carbon footprinting numbers look nicer, doesn't actually impact in any way the amount of CRH's emissions. So I think what we need to do here is try to engage with these companies to get them to reduce their carbon footprint rather than looking for a purely portfolio solution. So I hope that answers those members' questions in that area.
Thank you. I think that brings us to the end of today's session. So I'd like to thank everyone for taking the time to listen in, to watch the presentation, and that goes for whether you take the time to do it now live or whether you're going to watch it back later at leisure from the comfort of your own home and when you've got the time to do that. So thank you all for presenting and thank you all for attending.